What's up, outliers? Eric here from Outlier Trading, and today we are going to talk about a simple option strategy for trading a small account. When we have smaller accounts, trading in general is very difficult, but this strategy is going to offer you a viable route to add into your broader toolkit. So, the agenda is going to be walking through and analyzing some of the basic challenges so that we know what we're trying to solve for. We're going to talk about what some of the traits of a good beginner strategy look like. So again, we know what we're solving for. And then we're going to talk about the strategy. And the strategy is a vertical spread. We're going to talk about the different components of a vertical spread, different ways we can set it up to trade different ideas. So, before we get too far in, as you already know, we got to start with a disclaimer. I'm not a financial advisor. Everything in here is for informational purposes only, and I am not a part of Barchart. Simply enjoy creating content with them for you. So let's start with the challenges of a small account. It's kind of these two broad buckets. We have inexperience, and then we have limited capital. The inexperience component is about self-explanatory as could be. If you do not have the general skill to do something, then the probability of you being successful at it right out of the gate is very low. If you think of anything that you had to learn over the course of your life, whether it's a sport, a skill, they take some time. Now, the tricky part with trading is that learning curve, let's say if you like jujitsu, if you're in the gym practicing jujitsu and you get submitted, that's okay. You just restart the round and continue going, trying to pay attention to what went wrong. Well, in the markets, you can run out of money. So it's less forgiving for an inexperienced party. The next thing here, limited capital, it's not just the function of it takes money to make money. That's definitely part of it. But it's also the impacts of limited capital. Things like it's very difficult to build a robust, diversified portfolio if you run out of money trying to put on enough positions. It's going to limit the types of strategies that you can use. So limited capital adds a lot of other criteria that we have to pay attention to. Even things like pattern day trading rules will apply to us for accounts 25K or under 25K technically. So when we're trying to overcome these, there are a handful of things that we would be looking for. Something that's defined risk, something that allows us to capture basic profit mechanisms. This is things that aren't super complex for us to try and trade. So if you're trying to do some sort of volatility dispersion trading, that's not going to work for a small account, and it's also not going to work for somebody that's inexperienced. But let's say that before you turn to options, you had some experience swing trading stocks. Well, okay, you can take that skill set, that basic profit mechanism of trading things like momentum and drift and different kind of directional effects, and you can use a different security type options to trade those. The other thing to remember is as soon as we integrate an option, we now have a lot of other things that impact that position. If we take a look at an options chain, you can see here that we open up a bunch of different things we refer to as Greeks. We have delta, gamma, theta, vega, and these are only typically the first order Greeks, except for gamma, that's a second order Greek, fun fact. And there's second order Greeks, third order Greeks. There's a lot more that goes into an options price than what you see from a stock. So for a beginner that's inexperienced and isn't going to be as familiar with all of those different relationships, decreasing the impact of the Greeks is in your favor because it allows you to kind of start with training wheels on. And then obviously we need something that is capital efficient. If not, we are going to run out of money. Now, there's one really important thing to discuss briefly with respect to this whole thing that trades at the beginner strategy is also the mindset. The mindset of a new trader typically sets them up for utter failure right from the jump. And this is when we start with a really small account. We have $5,000 and we're trying to figure out how to turn that $5,000 into $1 million or into our future wealth. The reality is the probability of that happening is infinitely low. What is a much higher probability path is if you treat something like this, a beginner strategy with a beginner approach, and we're focusing on creating sound fundamentals and process in order to not trade successfully for a week, month, year, but literally over decades. So the entire purpose here is for us to get some real live market repetitions and to build a skill set. if you look at the returns that we're going to go over in general for a small account as a dollar amount, they're uninspiring. And that's just the nature of the reality of markets. It's not like easy returns are laying around everywhere. And that's actually a good thing, because if there were, then they would be consumed by much more equipped entities that would siphon them away. So the fact that it is difficult is good. So with that careful shift in our mindset, let's talk about the overview for the strategy. We're going to be looking at vertical spreads. Now, there are two different kinds and two different ways you can play them. We can either trade vertical spreads on the call side or the put side, and they can be short or long. It's going to consist of two legs in the same expiration of the same type, one long, one short. The main leg is whatever is closer to at the money or more expensive is the way to think of it. So let's take a look at a couple examples. If we take a look at QBTS, just because it's something random that I have up, and let's zoom this in just a little bit so that we can take a look at this together. Now, if we take a look at these handful of different vertical spreads down here, you'll notice that I have some in 16 May and 17 April, and you notice that the 16 May are ones that we're purchasing to open, and the ones out in 17 April are ones that we're selling to open. You'll understand why in a little bit. If we start with the call side, we can trade what's known as, sometimes they'll call it a bull call spread. I typically avoid those, and I normally just go with a call credit or debit spread. So in this case, this is a call debit spread. And you can see that this is a defined profit strategy. If we take a look, this represents the P&L, and then this represents the price of the underlying at different points. You can see that in this case, our debit that we're paying is 83 cents. So it means we're risking $83. And we're looking to make, in this case, just $17. Now, I'm not saying that this is the right way to set up the trade. I'm just showing you the profile, and then we'll get into some best practices in a little bit. I just want you to visualize what this is. So this is a long call debit spread, or a long call spread. Now, the idea behind this trade is going to benefit from two different conditions. The first one is if the underlying moves in your favor, and the second condition is if volatility expands. Now, one of the cool part about vertical spreads is they decrease the impact of a lot of the Greeks, and it's because of the long and short option paired together. Because they're paired together, they essentially offset the majority of one another. So if we take a look at this call spread that I'm showing you, the 9 and the 10, we obviously have 68 deltas here. We have 8 gamma, -3 theta, and 1 vega. And then if we take a look at the one strike wide vertical spread, you can see that it's a 59 delta, which is going to offset from the 68. The 2 gammas are going to offset completely. Same thing for theta. They're going to essentially cancel one another out. So the cool part about these kinds of strategies is that they decrease a lot of the impact of the Greeks so that you can learn to work with them over time. Now, the other thing you'll notice is that these are all $1 wide spreads. You can always choose to open up the spread wider. So in this very same scenario, we can maybe buy the 9, and then instead of selling the 10, we could sell maybe the 11 or the 12. So now we have a slightly wider spread. So what happens here is we effectively cap our risk based on the width of the spread. Now, in this case, it's whatever you pay. So for the long vertical spread, whatever your debit is, that's going to be your max risk. If we look at it from a short option perspective, so let's take a look at being short the 9 strike and buying the 8 strike, your max risk is the width of the spread, which is $1 less whatever credit you receive. So in this case, it's $1 less 42 cents, 58 cents, or $58 is going to be your max risk here. So the way to think about how do you pick if you're going to trade the call side or the put side, long or short, it's actually very simple, and I'll show you. We can use a little grid like this, and it's comparing high implied volatility and low implied volatility. And if you're not sure what those metrics would be, we can use something like implied volatility percentile, which plots the implied volatility of an option against itself. And actually very cool is if you take a look at something like Barchart, they have the ability to integrate that kind of metric inside of their screeners. So you can specifically look for this kind of condition. So flipping over to the options screener, and you can add it to the stock screener as well. What I've done is we have the implied volatility, but then we also have the implied volatility percentile. So it allows us to very efficiently look for things that meet our general criteria if we want to put on specifically a long or short put or call spread. So if we have high implied volatility, we're going to try to sell things. And if we have low implied volatility, we tend to try to buy things on the cheap. So if implied volatility is high, specifically implied volatility percentile is high, and we're bullish, that's when we would use something like a short put spread. So in this scenario of QBTS, just because it's up on the chart still, if we want to take a look at what a short put spread looks like right here, you notice that it has a very similar risk profile in all of those sorts of details. It actually will give you a larger profit window, especially as volatility is higher. So in this case, we are looking to make $42 and we're risking 58. So again, you can see that these are also very small trades. You're risking $58. Now, again, you're not making a bunch of money. If you're right, you're only going to get 42 bucks. But remember, we're looking to learn the skill. So this grid right here is a really simple way to see if you would prefer to buy or sell a call or put spread. Otherwise, they're generally interchangeable. There's not a lot of other differences because, again, remember that we're really isolating most of the Greeks that pertain to these because of the spread. Now, one other thing that I want to highlight quickly are some best practices. So liquidity when you're trading spreads is very, very important, which is the difference between the bid-ask spread. If you have a very wide spread, it becomes more challenging to put on multi-leg strategies. The next thing is you should be prepared to exit before expiration. And this is because even though you have a spread, you can find yourself at risk of early assignment. And I'll show you an example. So let's say some time ago, again in QBTS, just because we're here, let's say some time ago that you had the 10 and 9 spread, whether it's bull put or short call, like it doesn't matter. Any scenario where it's the 9 and the 10 strike. The reason why this is a problem is because one of those strikes is in the money and the other one is out of the money. So one of them would be assigned, the other one wouldn't be. So then you might open up the platform and realize that you have a little bit of a mess to deal with. So one of the best things you could do here is just always have a plan to exit these before expiration so that you don't deal with that. And this also extends for early assignment. If you have a short option as part of your leg and the extrinsic value goes down to a tiny little bit amount, you are at risk of early assignment, higher risk if you have a short call part of your trade with the dividend coming up. So another scenario where you want to monitor the extrinsic value and then take an early exit if you need to. Remember, we're looking to focus on the skill set of trading different profit mechanisms, and we care way more about the percent return in these instances as compared to the dollar return. So this is probably one of the simplest strategies you can start with. This isn't something that I would trade forever. I still trade them now, but over time we try to simplify the number of legs and things like that. But in the beginning, this is a great way to get some repetitions under your belt. If you have any questions, let me know. Be an outlier. I'll see you later.